Hey fellow investors, welcome back to the channel. When people think about dividend investing, they often imagine stability, predictability, and businesses that look roughly the same year after year. But every once in a while, even the most boring stocks go through changes that fundamentally alter how we should think about them. And when this happens, we need to reassess the fundamentals from scratch and decide whether management's future promises are likely to materialize. In this video, I want to talk about two dividend stocks that have gone through massive structural changes over the past year or so. These are not companies that are collapsing. Instead, they are companies that have deliberately reshaped themselves, sold assets, reset earnings, and left the market with a much harder question to answer: what are these businesses actually worth now? Both of these stocks fall squarely into my I'm eyeing category, not because the upside is obvious, but because the market is struggling to price the transformed businesses. And whenever that happens, it's worth slowing down and thinking carefully rather than reacting emotionally. That's exactly what I've done for myself, but I'll be sharing them with you today. Before we start, a reminder that this video is for informational purposes only and not financial advice. Always do your own research and consult a licensed advisor before making any investment decisions. I own some of the shares discussed, but remember, what works for me might not work for you. Alright. Let's start by looking at the first stock that has undergone massive changes recently. Centurion Corporation. From landlord to capital recycler. Centurion Corporation is a Singapore-listed company that, for many years, was best understood as an owner and operator of large-scale accommodation assets. Its core businesses were purpose-built worker accommodation in Singapore and purpose-built student accommodation in markets like the UK and Australia. To be frank, many investors found the sector to be boring. It wasn't flashy, like luxurious hotels or high-end serviced apartments with swanky branding, but it was much more predictable due to the longer-term contracts. Beds generate rent, occupancy tends to be resilient, and cash flows were relatively stable. For dividend investors, it sat comfortably in that category of niche real estate names that quietly did their job. That perception changed in a very real way with the listing of Centurion Accommodation REIT, or CA REIT. This was not a small corporate exercise. By injecting a large portion of its accommodation assets into CA REIT, Centurion effectively sold about 54% of those properties to public investors while retaining about 46% as a sponsor stake. Overnight, Centurion stopped being just a landlord and became something more complex: a REIT sponsor, a capital recycler, and a platform business. From a balance sheet or book value perspective, this move did not destroy value. Centurion didn't give assets away cheaply or lose control in a reckless way. It converted physical properties into cash, balance sheet flexibility, and a listed REIT stake with a transparent market value. On paper, value was repackaged, not erased. But markets don't price companies on book value alone. They price earnings, and this is where the real adjustment happened. Before CA REIT was listed, Centurion consolidated 100% of the earnings from those accommodation assets. After the listing, a significant portion of those earnings now belongs to CA REIT unit holders. Centurion still receives distributions from its retained stake and earns management and property management fees, but the parent-level earnings base is meaningfully smaller than before. Investors responded quickly to this reality, with some analysts cutting Centurion's earnings forecasts by roughly 35% to 45%. This wasn't a judgment call about business quality. It was arithmetic. This distinction matters. Centurion did not suddenly become a worse operator. Demand for worker accommodation and student housing didn't collapse. What changed was how earnings were split. The market's reaction, however, went further than just adjusting earnings models. Centurion's share price fell from a peak of around $1.80 to the $1.20 to $1.30 range. However, this is still significantly higher than the start of 2025 when it was trading below $1. This is where it gets interesting. When you break down the valuation at these levels, something very revealing appears. Centurion's retained stake in CA REIT alone is worth roughly about $1 per Centurion share at current prices. In other words, the market is valuing almost the entire company on the basis of its REIT stake and assigning only about 30 cents per share to everything else. That 30 cents is meant to represent Centurion's remaining operating businesses, its management and property management income, its development pipeline, its balance sheet flexibility, and its ability to redeploy capital earned from the REIT listing into new assets. Put differently, the market is assuming very little value creation beyond what already exists. This is where the Centurion story stops being about real estate and starts being about capital allocation. By selling about 54% of the CA REIT properties, Centurion unlocked a significant amount of capital after accounting for debt effects, capital that now has to work just as hard as the properties it replaced. At today's share price, the market is implicitly assuming that this capital will earn very low returns, perhaps somewhere in the low single digits. That may sound harsh, but it reflects genuine uncertainty. Redeploying capital takes time, development carries risk, and sponsor models only work if management executes well. If Centurion executes well, the market's current pessimism may turn out to be excessive. To be fair, management has already set out its priorities, venturing into new markets like the Middle East or China, expanding into different segments like quick-build dormitories or QBD in Singapore, and curating a pipeline of assets for CA REIT. On the other hand, if Centurion runs into execution risks, today's valuation may be fair. For now, this is a transition story that deserves attention, patience, and a watchful eye by savvy investors. This is why I'm eyeing Centurion rather than buying it outright. The investment case no longer hinges on whether accommodation demand is resilient. It hinges on whether Centurion can prove that it can redeploy capital at reasonable returns, rebuild earnings over time, and justify a valuation that goes beyond simply owning a REIT stake. Before I continue, just a quick note for those of you who want a deeper dive into how I think about dividend stocks and REITs beyond what we can cover in a single video. I've been steadily building out more written analysis and longer form breakdowns over at thedividenduncle.com, where I go into more detail on the analyses, portfolio construction, and how I think about income sustainability over time. If you prefer reading at your own pace or want a reference point you can come back to later, feel free to check it out. I'll leave the link in the description below. Now, moving on to the next stock. I'm eyeing DFI Retail Group. Portfolio compression, not liquidation. The second stock I'm eyeing, DFI Retail Group, sits at the other end of the business spectrum. This is not a niche real estate name. It's a long-established Asian consumer retail group with operations spanning supermarkets, convenience stores, health and beauty, and home furnishings across multiple markets. For years, DFI was viewed as a defensive consumer staples play. People still buy groceries and personal care products in good times and bad times. But over the past few years, DFI has undergone a transformation that has unsettled many investors, particularly because it involved a long series of asset sales and divestments. At first glance, these moves can look alarming. Exit Malaysia Grocery. Exit Indonesian supermarkets. Sell minority stakes in Yonghui and Robinsons Retail. Sell Singapore Grocery. Exit Manning's physical stores in mainland China. If you simply count the number of disposals, it's easy to conclude that DFI is shrinking itself into irrelevance or slowly liquidating the business, what some might call a voluntary liquidation. But I think that interpretation misses the underlying strategy. What DFI has been executing is better described as portfolio compression. The company has been deliberately exiting businesses that are capital-heavy, margin-thin, or structurally difficult without sufficient scale, while recycling capital into formats that are more controllable, higher margin, and more repeatable. Take grocery retail as an example. Grocery is a brutally competitive business that requires enormous scale to win on pricing, logistics, and rent leverage. In markets where DFI lacked that scale, the business became a grind. Exiting Malaysia Grocery, Indonesian supermarkets, and eventually Singapore Food and Grocery was less about abandoning food retail and more about acknowledging where DFI could not compete effectively. Just take Singapore's grocery scene for instance. When you put cold storage side by side with Shengxiang or Nchuk Fair Price, it is hard to see how it could compete with these local retail giants. At the same time, DFI did not exit markets entirely. In Indonesia, it pivoted fully toward Guardian and IKEA. In Singapore, it doubled down on Guardian and 7-Eleven after selling the grocery business. These are formats with clearer margin structures, better brand differentiation, and more pricing power. The sale of minority stakes in Yonghui and Robinsons Retail follows the same logic. These were capital-intensive investments where DFI did not have operational control. Selling them freed up significant capital and strengthened the balance sheet, giving DFI more flexibility to reinvest in businesses it actually runs. The most recent exit, Manning's physical stores in mainland China, is perhaps the clearest signal of discipline. Rather than persist in a format that struggled to scale offline, DFI chose to stop bleeding resources and explore a cross-border e-commerce model integrated with Hong Kong and Macau operations. This is not retrenchment for its own sake. It is an attempt to allocate effort where it has a fighting chance. After all these moves, DFI looks very different. It is no longer a broad Asian supermarket conglomerate. It is increasingly a focused consumer retail platform anchored by health and beauty through Guardian and Mannings in Hong Kong and Macau, convenience through 7-Eleven, and a differentiated home furnishings business through IKEA. Food retail doesn't disappear entirely, but it becomes more selective and Hong Kong-centric, where DFI has scale and defensible market positions. This matters because it addresses the biggest investor fear. Is DFI becoming a voluntary liquidation? The answer, based on what has actually been sold and what has been retained, is no. DFI has not sold its core profit engines. It has sold low-return, non-controlling, or structurally difficult assets. That is a very different thing. That said, the investor's discomfort is not irrational. Asset sales and special dividends, including the large special payout in 2025, reduce future earnings capacity unless the remaining businesses can grow. DFI's earnings profile has been reset, and the company now needs to prove that health and beauty, convenience, and IKEA can carry the group on their own. Analysts who have engaged closely with management appear cautiously optimistic. Following DFI's Investor Day, several brokers raised target prices and highlighted clearer earnings targets through FY 2028, driven by margin expansion and operational focus. But even here, the tone is not euphoric. It is measured. The market wants evidence, not promises. This is why DFI, like Centurion, sits firmly in my I'm eyeing category. To be clear, I am already an investor in DFI and have been happily seeing its share price rise over 2025. But as always, I'm always on a lookout to increase my holdings on quality dividend stocks. The value unlocked through disposals is real. The strategy is coherent. But the risk is no longer about solvency or survival. It is about whether DFI becomes too narrow and settles into a low-growth, low-multiple defensive retailer, or whether disciplined focus actually leads to better returns on capital and sustainable earnings growth. The dividend uncle's take. When I step back and look at Centurion and DFI together, what excites me isn't that they look cheap on a spreadsheet, or that their dividends are unusually high right now. What excites me is that both companies are going through massive transitions, and the market is still trying to decide what they should be valued as on the other side of those changes. In both cases, the easy narrative has already played out. Assets have been sold. Earnings have reset. Dividends have been adjusted. That part is done. What the market is struggling with now is how to price what comes next, because what comes next depends heavily on execution rather than history. For Centurion, the story has shifted from being a straightforward accommodation landlord to becoming a REIT sponsor and capital recycling platform. The market clearly recognizes the value of its retained CA REIT stake, but it is far more skeptical about how much value Centurion can create with the capital it has unlocked. At current prices, expectations are low. That's not a guarantee of upside, but it does create an interesting setup if management can show that earnings can be rebuilt over time through disciplined reinvestment and pipeline execution. For DFI, the transition is different but the tension is similar. Years of portfolio compression have stripped away businesses that were capital-intensive, low-margin, or lacking scale, leaving behind a much more focused consumer retail platform. Health and beauty, convenience, and IKEA are now expected to carry the group. The market is no longer valuing DFI as a sprawling Asian retail conglomerate, but as a tighter, more defensive operator. That simplifies the story, but it also raises the bar. The remaining businesses now need to prove that they can grow earnings and deliver acceptable returns without relying on further asset sales. What I find compelling about both companies is that they are no longer being priced for optimism. The market is cautious, perhaps even impatient. It wants proof. And that's where opportunity can sometimes emerge for long-term investors who are willing to wait through uncertainty rather than demand immediate clarity. At the same time, this is exactly why I'm not rushing in blindly. Massive transitions create potential, but they also create execution risk. Capital needs to be deployed well. Earnings need to stabilize and then grow. These are not boxes that get ticked overnight. So heading into January 2026, I'm approaching both Centurion and DFI with genuine interest and growing attention. I want to see early signs that capital allocation decisions are translating into real earnings outcomes, and that the new, slimmer versions of these companies can stand confidently on their own. If those signals start to appear, these are the kinds of stocks that can move from being interesting stories to becoming investment candidates for my hard-earned cash. That's all for today, folks. I hope this analysis has given you something to chew on as you think about investment ideas heading into 2026. I'd love to hear your thoughts in the comments, whether you like the changes these two companies are making, or if you're already a shareholder. For me, these are transition stories that deserve patience. I'm watching closely and giving them the time they need. Before you go, if you found this useful, do give the video a like. It really helps support the channel. Thanks for watching, and I'll see you in the next one.